Hey, before we get started today, I wanted to just acknowledge what's happening in the world right now. I always get frustrated with brands that keep posting and keep moving about as if nothing's happening when things are happening. Even during COVID, we saw brands change their message fairly quickly. And I think what's happening in the world now with Russia's invasion of Ukraine is something that I want to know, our listeners to know, that we're obviously very attuned to what's happening over there. We're not just going about our daily lives. At least I'm not going about my daily life thinking that everything's normal, when certainly the world right now does not look very normal. One of the things that came to my mind recently was, there was a time period when things would happen like this, and leadership in our country would call for a national day of prayer. And you don't see that as much anymore. And I guess that's because it's maybe not politically correct. Certainly God does not appear to be politically correct in this current environment that we live in. So I started searching that a little bit before this podcast today. And I was reminded, or I was guided to a section in the Bible. It's Acts 4:29 through 30. The apostles were arrested and forbidden to preach the gospel, and they prayed, and this is what the quote is: "Lord, look upon their threats and grant to your servants to continue to speak your word with all boldness, while you stretch out your hand to heal, and signs and wonders are performed through the name of your holy servant, Jesus." And as a result, the passage continues, when they had prayed, the place in which they had gathered was shaken, and they were all filled with the Holy Spirit and continued to speak the word of God with boldness. That's probably the basis of a National Day of Prayer. I went back and looked through history a little bit. I noticed that Britain issued 7 calls to prayer during World War II. First was called by King George VI on March 27th of 1940, when 350,000 British soldiers were trapped in Dunkirk. History calls that the miracle of Dunkirk. Some 330,000 men were then rescued. The second and third National Day of Prayer came during the Battle of Britain, when Nazi air forces were defeated by a relatively small British force. An Air Chief Marshal named Hugh Dowding later testified, "I will say with absolute conviction that I can trace the intervention of God. Humanly speaking, victory was impossible." The fourth Day of National Prayer was called by the King in Parliament for March 23rd, 1941, as Hitler was planning to invade Britain. A great earthquake created waves and terrific gales that blew the Nazi ships 80 miles off course. British Navy defeated the Italian fleet in the Mediterranean. Ethiopian ports were liberated. Yugoslavian forces organized resistance to Hitler, and as a result, Hitler gave up invading Britain. The fifth Day of National Prayer was on September 3rd, 1942, the day that Palermo in the Mediterranean, and the entire Italian fleet was sunk that day. Sixth Day of National Prayer was on September 3rd, 1943, the 4th anniversary of the outbreak of war. That very night, Italy surrendered to the Allies, and the dictator Mussolini was murdered. The seventh day and the last Day of National Prayer was called by the King in the spring of 1944, prior to D-Day. Dwight Eisenhower reported later, "If there was nothing else in my life to prove the existence of an almighty and merciful God, the events of the next 24 hours did it." The greatest break in a terrible outlay of weather occurred the next day and allowed that great invasion to proceed. Obviously, we all know that D-Day led to victory in war in Europe. When you look at the people of Ukraine right now, it doesn't look very promising. As I speak, we see a 40-mile convoy starting to surround the city. But I would encourage all of our listeners to pray for the people of Ukraine, that they also might get a break and be able to defeat their enemy. Very sobering as our lives continue somewhat normally here. Yep, we might pay a little bit more for gas. We might not be able to get that part that we're looking for. But no one right now is holding a gun to our head over our freedom. So let's all pray for the people of Ukraine as we go about our day. Welcome to a Wiser Retirement Podcast, where we cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith, guiding you to financial success. This is my co-host, Brad Lyons, today. Hey, Brad.
Hi, Casey.
We have been working hard, upgrading some equipment, and we have started doing videos of our podcast. So as we are recording this for you, we're also putting this on our YouTube channel, which is also called A Wiser Retirement, or you can search for Wiser Wealth Management. And you can find the videos of the podcast as well as bonus features that Matthews and you have done, myself as well, talking about different topics. I did one recently on inflation and what's happening with that and risk respect to our portfolios. I think Matthews did one recently, maybe on Medicare. Can't remember the exact topics he did, but we have other things we experimented too over the years that are all archived there inside the YouTube channel. So be sure to check that out. Today, our topic is alternative investments, and I find this space very interesting, mainly because we're so used to like traditional mutual funds, and then ETFs came along. But there's some really good talent inside alternative management, but there's also a lot of gotchas. That's where we see fraud, right? We see people getting in a lot of trouble for doing really bad things. So you kind of have to walk lightly and make sure that you're working with reputable companies and you're not have some fly-by-night organization that's promising
very true.
Big returns.
As an investor in private or alternative investments, you're stepping into a whole nother world of investing. And that world is largely unregistered and unregulated. And that's part of the reasons why you see some bad actors in that area, and why it takes a great deal of due diligence on the part of the investor or the part of the investment professional who recommends alternative investments to their clients for their investment. So it's another level of investing and due diligence that's required for portfolios.
We've touched on this here and there. I don't know if we've ever done a podcast on just commodities, or the only thing, I guess it's kind of falls into alternatives would be SPACs. We did a podcast on SPACs, but this is an area we haven't really touched in, partially because we don't do much in this space even for our own clients. I get a lot of phone calls, a lot of emails every single month about, hey, invest in this new hotel that we're building over here, or
those would be from sponsors, right?
Correct.
They're asking us if we want to review their investment for our clients. So,
we tend to stay away from that just because there's so much risk on that front. And we've had our own private equity funds in the past that we've run ourselves. Mm-hmm. Those have all expired and have been finished. I think we did 5 of them, 4 very successful, 1 not so successful. But that's the nature of that.
It is
of that type of investment too, and the risk that we take. I will say, in my time of running our last private equity fund, I've never met in my life so many people that are out to get you. It's all about them, and then how can they screw you over? It's very scary. It's very scary. So you have to tread very lightly. But there's also other ways to do this that are much less scary, which we'll talk about today. Let's just start. First of all, was alternative investments. What is that? How do you define that?
Well, in some respects, it can be defined as what it's not. It's not a traditional publicly traded investment such as stocks, bonds, and cash. So you can look at it as anything outside the realm of a publicly traded investment. Otherwise, you could look at it as could be real estate, timber, forestry, private equity, venture capital, distressed securities, hedge funds, and other things such as natural resources or commodities, which we're going to talk a little bit about, collectibles, art, wine, antiques, coins, stamps, carbon credits, film and production credits, derivatives, cryptocurrencies is a new one that's obviously come online, and
some
then
people say that
non-fungible tokens, could be considered.
Some people say
an alternative.
cryptocurrencies is an asset class, but we'll say alternatives for now.
For now, So again, let's just go back and say what it's not. It's not traditional publicly traded stocks, bonds, or cash.
Got it. So all those things you just labeled off to me seem very illiquid. Probably have to hold it for a long time.
Right. It has certain characteristics that also make it unique. Illiquidity is probably the most well-known one. These types of investments generally have a lifespan, as you talked about with the private equity funds that you've had, of 10, 12 years easily. Okay. Mm-hmm. And the idea being is that it gives the manager a longer period of time to consider the investments that they want to make in the fund, the limited partnership or alternative investment arena, so that they can then, produce the greatest long-term returns without worrying as much about the next quarter or
right.
being, ranked against his peers in the public marketplace. So, most are structured as limited partnerships. They're unregistered with the Securities and Exchange Commission, which requires a higher level of due diligence on the behalf of the investor or the investment professional. And as a limited partner, an investor goes in and works with or contributes money with other limited partners, and then the general partner in the partnership is charged with managing the funds themselves. So you're turning it over to a general partner, and the limited partners then are investors in the fund that the general partner manages. And these, again, are unregistered with the SEC. They're not required to report returns in the same manner, in the same time frame as SEC regulated mutual funds, ETFs, stocks, etc. One of the unique characteristics of alternative investments, limited partnership structures, are their fee structures. In the mutual fund world, we know that fees can be anywhere between 0.5% and as high as 2%. Sometimes on a sales charge, 5.75%, et cetera. Mm-hmm. In the ETF world, we know that those fees have dropped dramatically, and when we look at ETFs for our clients, we're looking at ETFs that are anywhere from 2 to 3 basis points up to somewhere in the mid-teens on the high end, depending on what that particular ETF has to offer. So it's these types of alternative investments, and especially in limited partnerships, have fees much higher than that. Could be as high as 2%, and the general manager may have an interest in the profits that are earned in the fund that they produce for their limited partners. So what you see is you have a level of structure of fees in limited partnerships and alternative investments that often don't even exist in the same types of publicly traded investments. So you have a management fee and what's called carried interest, and there are clawbacks, there are all sorts of things. The legal contracts that go along with limited partnerships are extensive and require legal review quite often before.
Well, for private equity, 2 and 20 used to be pretty common.
Right.
2% fee and then 20% of the profits.
Sure.
That's starting to fall. I've seen 1 and 10 or different various structures.
Right.
They're starting to be a little more popular.
So with all these, restrictions of time, higher fees, not as much transparency in the underlying investments, why would somebody invest in these types of investments?
Well, most likely you're hoping to get outsized returns. So you're over a long time period, you're hoping you can get a different return than what you have gotten in stock and obviously bonds. But S&P 500 has been hard to beat.
Yes, it has over the past 10 years, as we know.
Coming out of the financial crisis is when we started adding some private equity to our funds. And even going back then to now, S&P, you can't beat that. But that being said, for certain investors, you've got $10 million in traditional stocks and bonds. You've got another $3 million to invest. That may not need to go into traditional investments. That could go into an alternative asset class.
That's right.
And so they're looking for different returns. And private equity can be made up of a lot of different things. You could buy a private equity fund that owns just real estate or is in the real estate space. You can buy a private equity fund that owns other businesses or is trying to launch businesses. So there's different level of risk on every single document that you sign. That's called the subscription agreement. Is going to be a clause that you could lose 100% of your money.
Right.
So that should be very clear when you
may not have any recourse whatsoever.
As a qualified investor, you wouldn't.
Right.
But
that's right.
But so anyway, the you're looking for outsized returns or returns from different asset classes that are probably not readily available to invest in, or you don't have the resources to buy directly yourself.
Right. So as an alternative investment investor, especially in limited partnership structures, the investors have to be accredited, it's called. It means that they have to have at least a certain level of financial knowledge and resources for themselves. And the idea being that should things go wrong and in this investment that they make goes completely south,
right.
That it doesn't take on their entire net worth. So an accredited investor, in order to invest in some of these alternative investment structures, requires an individual to have at least income of at least $200,000 a year, or if they're married and couple together, has $300,000 a year. And they must have at least $1 million of liquid net worth,
or
$3 million or $1 million of net worth, excluding the value of their home. Okay.
Right.
So it has to be assets outside it. So you just create a simple balance sheet for yourself and exclude the value of your home. Take all your assets, add them up, reduce it by the amount of your liabilities.
If your brokerage account's over $1 million, you're qualified.
You're done. You're ready to go. Okay. So right away, it takes a completely different level of investor in order to get into these. And we're looking for, as you mentioned, higher returns and something else called non-correlated returns, something that's not correlated to the general stock market in the return stream. And by having these time frames that last, as many as 10 to 12 years, quite often in some of these investments, it allows the general partner to expand their opportunity set for looking for investments, and it gives them the time to find the ones that they think are and select are the best for the funds themselves, without worrying about the next quarter's return, the next year's, et cetera, because investors are locked in there for 10 to 12 years quite often. So when you look at some of these different types of investments, there are really kind of 3 or 4 well-known ones. Okay, we mentioned one, private equity. Okay, real estate is often thought of as an alternative investment. It's been around forever. Mm-hmm. Owning real estate has always been a great investment. Commodities, natural resources, and commodities are considered an alternative investment. And hedge funds. Hedge funds are the ones that we hear a lot about in the news, hedge fund trading, okay, and how that occurs. So let's take a look at some of these, if you like. And let's take a look at real estate. Most people are familiar with real estate. Through real estate investing, there's different types of real estate. There's structured in limited partnerships. It's structured now in public equities and something called Reits, which we invest in for clients. And then there's personally and privately owned real estate.
Yep,
that's an investment. And who's not familiar with Airbnb,
right,
or
exactly.
VRBO? It used to just be a rental house.
That's my favorite. That's my favorite alternative investment. I mean, we've told many clients that when you are getting ready for retirement, you go through that what we call I call it the bucket system. It's more like a checklist, really. But get rid of all your stupid debt. No Amex cards at 25% interest, right? Then the next thing, we're gonna make sure we have enough savings and reserve for emergencies. Then we're gonna make sure we're saving enough for retirement. That's what retirement planning is about, right? Then we're gonna make sure we've got college covered based on what our objectives are. Every family has a little different objective for that. Then after that, then we kind of start moving into what we call the opportunity fund. So inside the opportunity fund, that's where the real estate can start coming from. You start sending that extra money every month into this opportunity fund. And we manage that for clients, but we know that we may have to liquidate that. So we manage it a little bit differently. And eventually you've got a couple $100,000, which is a great down payment for something bigger, right?
So we're exchanging one asset class for another in that instance.
Exactly.
Okay? And in these privately owned real estate properties, you have both personal use and income producing use all at the same time.
Right.
So it can be a great deal. So that's an example of privately held
Especially
real estate.
now with the cost of real estate being so high that I don't know that the yield looks very good to buy a real estate property and then put a long-term renter in it. It's almost like you need that vacation rental because you get more per week. If you rent your beach house out for 4 years or a year at a time, you're going to get a lot less money than if you do the weekly, right?
And theoretically, you could adjust your rates on a weekly basis.
That's right.
From one renter to the next.
Yeah.
Right.
Airbnb already does that. They optimize it. So as more people book in that zip code, in that area, and as things start closing up or become less available, then they start increasing the price automatically. So there's all kinds of ways you
Supply and demand.
You can increase.
Economics
It's kind of like
101.
how Uber works, I guess, too. The cars cost more during peak hours, right?
Yeah.
So, yeah, I think that's a great investment.
Sure. REITs, of course, are real estate investment trusts. They're publicly traded, and they also provide an alternative, non-correlated return stream for investors, and generally a higher rate of interest than regular bank accounts and publicly traded securities like stocks. So there's different ways to invest in real estate as an alternative investment. Private equity is an interesting. We've talked a little bit about this. Private equity comes in many flavors. Okay, private equity can be real estate. Okay, private equity can be investments in private companies. It can be investments in public companies in a structured, such as a limited partnership.
Right.
Okay. Generally, when you think of private equity, you do think of investing in companies during their startup phase or during a transition phase. That if somebody who owned a factory, okay, for example, and they've owned it for years and it's grown, and then they want to sell it off, they want to expand their opportunity set, they want to have what's called a liquidity event, they may sell it to a private equity fund who then manages the business and transitions it back to a private or another private company, or even taking it public at some point in time in the future. Other ways that private equity GPs will buy into companies is that they'll just buy the company right off the exchange. Mm-hmm. They'll invest all the money to buy the entire company. And the reason they might do that is they see that within that company, something might have gone awry, and they're going to take over, do some work with the management, reinvest more money into research and development and production, and then see the fruits of that work over the number of years. And that's why we may be looking at a 10 to 12 years period. In private equity, there is a series of events that occurs. First event is that you're calling capital and you're raising capital with investors. And then you deploy that capital over time as the manager buys companies. And then they have something called a period of harvesting later on. So you have your initial investment, you have the operating capital, and then you have harvesting that capital at the same time. And during that period, investors may have experienced something called a J-curve. And this is something that individual investors aren't really familiar with. And that's why it requires an accredited investor or large pools of capital to invest in these types of funds. Because as you can imagine, as you buy a company, you're paying for it, and then you're investing even more capital in that to improve it. And so the valuations may have a downward slope at first, but then as they improve their operations and grow their revenues, they have an upward swoop. And if you look at that on a letter, it looks like a J, and it's called a J-curve. Mm-hmm. So you have something called a J-curve in the private equity world that most individual investors aren't familiar with, and it has to be considered in your long-term return stream. Private equity is priced differently as well. It's not priced on a day-to-day basis. It's generally priced on a quarter-to-quarter basis. And then at year end, it takes even longer for the audits to come in on all the different companies that they've invested in. So by nature, you're going to have a lower standard deviation because you're only pricing 4 times a year in your portfolio's valuation. So instead of having the ups and downs of the daily markets that we see in the Standard & Poor's 500, for example, we're only pricing this, I say we, but GPs are only pricing this 4 times a year. So your standard deviation of your overall portfolio goes down, okay? And hopefully the return goes up. But these returns have a lag time, as you recall.
Yeah, it takes a lot of patience.
Takes a lot of patience. So you have to have a very long time frame. In the private equity world, there's investors can go in, and the regulations have changed as they've been democratizing, these alternative investments. And some of them are offered in fund of funds. Some are now offered in ETFs, which we're going to talk a little bit about. But doing the due diligence on these types of investments is imperative, because the dispersion of manager returns, as you had mentioned, there are some that just aren't very good, and there are some that are very good. Whereas the dispersions of returns in publicly traded markets is much, much smaller. So in a global private equity sense, returns for a 10-year period recently ranged from 3.3% to 22%. Okay. Yeah. That's huge. Okay. The range for publicly traded investments for the same time period was somewhere between 10% and 13% on average. So what you're looking at is a much greater dispersion in alternative investments of the managers who are managing the money for you. And so it takes a great deal of due diligence and manager review before you should make an investment in that asset class.
Speaking of making that investment, what percentage of a portfolio do you think should go into alternatives if you're a qualified investor or accredited investor?
That's a great question. First of all, it has to be enough to move the needle.
Yeah, if you put 1 or 2%,
forget it.
It's not going to matter.
No.
It's not worth the paperwork.
That's right. And at the other end of the spectrum, you don't want to have so much in it because of its liquidity or illiquidity, lack of liquidity, that you don't have enough to live on during the time period that you're invested in the alternative private investment.
Or if it goes bust, it alters your life.
It can. Okay. So at least 10%, probably no more than 20%, I would say, for a private investor. Now, traditionally, these types of investments have been the playground of the rich and famous, and what happens there is they have so much money that they can put more money into it, and even if it does go bust, it doesn't move their needle too much.
Right.
Or endowments and pension funds have always been big investors in private equity. Endowments, especially David Swenson, who was the endowment manager at Yale, rethought the whole idea of an endowment fund's lifespan. He considered to be practically infinite.
Right.
Okay. So he raised the amount of alternative investments as a percent of the entire endowment up to around 40 to 50%.
Wow.
Okay. Wow is right. Okay. And as these different types of funds that he had invested in for the endowment were harvested and reinvested and going through their seed period and their capital raising and operating period and harvesting period, they were all coming due at different times. So he created a cash flow in that manner. That's very difficult for the individual investor to have that much money. And because of the high minimums, these are often $250,000 or $500,000 just to invest.
Right.
So it takes a lot just to to invest in them, and then to create a diversified portfolio of them takes even more time.
Right.
So within an infinite time frame and a large sum, you can raise that amount higher into your portfolio as a proportion. But as an individual investor, 10, no more than 20% at all. And that even depends upon where you are in your station in life.
True. You've got some examples for us, some models, right?
Right. Okay.
So these are all things that anybody could purchase. This is for the most part. I mean,
yes. And that was what we wanted to do here today, is that not only to give some ideas about what alternative investments are, but then how they fit into a portfolio and what they can do for you. So we're going to look at private equity in a stock portfolio. We're going to look at real estate in a stock portfolio. We're going to look at commodities in a stock portfolio. And we're going to look at adding a hedge fund to a stock portfolio and see the effect on it versus just the stock portfolio itself.
okay.
Okay. So
And I have not seen these results, so I'm interested in learning this too.
Well, it's very interesting because it has a noticeable effect on the portfolio. And the idea is then to optimize the proportionality of the stocks to the alternative investments in order to maximize either the return and minimize the risk,
Right.
or at an equal risk, maximize the return. Okay?
Gotcha.
So for the stock portfolio, we looked at Vanguard's total stock market. Okay, not to select any sort of particular manager or
Yep.
any segmentation of the market, but just the total stock market. Okay, so that
large,
becomes our
mid,
benchmark.
small, that's our benchmark.
Mm-hmm.
All the U.S. stocks, basically.
Okay, now let's add to that private equity. And compare it.
And what he's doing is he's typing this into his into our software to basically see what the rate of return and what the risk does as he's adding different alternative investments to the portfolio. And obviously, this is historical, so it's not forecasting the future. But
That's
looking
right.
Back into the past.
Right. So if we were to look at adding private equity to a stock portfolio, okay, and then optimizing it where the return and the risk associated with that are correlated to get the maximum benefit of it, we'd see that somewhere around 50% of a portfolio invested in a diversified stock fund and 50% invested in a diversified, what's called a fund of funds of private equity, would produce a very similar return relative to an all stock fund. Okay, the all stock fund at the return level, this kind of goes, going to go back and forth a little bit between these two. A 50% private equity exposure plus 50% public equity exposure has a risk of 14, an expected return of 6.6%. Okay. So on a stock portfolio alone, we have a similar structure where we see a risk of 18.2 in the stock portfolio.
So we reduced the volatility by 4%.
That's quite a bit. Okay.
And the rate of return is
in the all stock portfolio is 7.1. So we've reduced the return by 0.5% while reducing the risk of the portfolio by 400 basis points, 4%.
4%.
Right.
Yeah. Interesting. But nobody's going to put 50% of their money into
No,
private
that's just
equity.
an optimizing, portfolio in a hypothetical situation. Right. So, but through the software, we're able to take a look at what that is. So then you start dialing back the numbers a little bit. Was what would 20% do? What would a 10% allocation do?
Right.
But you can see you can either raise the return or lower the risk of the portfolio because of the return stream offered in each investment asset class here.
So what that tells me is that I could get the same amount of rate of return, but I'm getting a lower risk, not because it's less risky. I'm getting a lower risk because they only report the price 4 times a year.
Well, that's correct. It
So-
has a stabilizing effect in your
Right.
portfolio.
Yeah, it does, but it doesn't mean the risk is not there. It could be more risky.
It could.
All those companies in that private equity fund could go out of business, much more so than a publicly traded company, right?
That's correct. And that's why the due diligence of a general partnership
Right.
is so important.
Where if it's made up of real estate, that's less risky because there's if it's assuming it's not over leveraged, it's
Right.
you've got the ground beneath it at least, and the building itself. So it's hard to compare apples to apples because you have to actually look at inside this particular fund. I don't know how many private equity funds are in the fund of funds. I'm guessing it's probably 40, 50 plus that are inside that. We've actually done our due diligence on this fund. It's probably been 2 years ago.
Yes, and what happens is the fund manager buys other funds, and inside those funds are companies themselves.
Yes, exactly.
So you get a multiplier effect. So there's
Right.
as many hundreds of different companies in the portfolio itself.
Which reduces your risk, but also dilutes the return.
That's correct.
It's not much different than buying individual stock versus an index fund. We could pick 10 stocks, and if they're the biggest performers of the 500 of the S&P 500, we're going to way outperform the S&P 500.
Oh, absolutely.
But we could also go the other direction.
That's right. And create a larger volatility of return.
Exactly.
Dispersion. So
exactly.
So now let's take a look at real estate. Let's add real estate to that stock portfolio. And where is it optimized? Well, interestingly enough, it optimizes somewhere around 65% stock and 35% real estate investment trust in this instance. The expected return is about 6.9% with a risk of 15.7. So again, we're having that very, very, very close return of an all-stock portfolio, which was 7.1 expected return.
Right.
Here we have a 6.9% expected return, but we've reduced the volatility again from over 18 to a little over 15.
Yeah, and that makes a little more sense because those are mostly publicly traded REITs,
which are priced on a daily basis and subject to
and you're actually
the marketplace.
Receiving income from it
as
well.
Yes.
Yeah. 35% in real estate sounds pretty heavy, but if you think about it, if you own your own home and you own a second property, it could be bigger than that
easily
in your own portfolio.
Easily. And again, this is just optimized. It's not optimized towards including bonds or any other asset class. We're just taking the two asset classes.
Correct. All the software is doing is trying to figure out what mix of assets do we need to create an optimized portfolio.
Right.
And in this case, we're only using two asset classes.
That's right. So you're just looking at the two. So here, an asset class we didn't talk a whole lot about. We can spend a little time. We're looking at adding a hedge fund to an all-stock portfolio.
And how did you replicate that?
There's an ETF out there that's offered, and it's a long-short hedge fund that's actively traded, actively managed, I should say, and it replicates, a real hedge fund offered through other structures. So it's a long-short fund where the manager can go long positions, which means they're going to buy stocks, and it can also short stocks, which means it's going to expect the market to go down, and they'll recoup and then get their gains when the markets go down. So whether the market goes up or down, that manager is looking to make money on either side of that trade.
Interesting.
Yeah, it's a whole nother world.
That's what everybody wants. They want to make money both ways. I always tell people they can't do that. So I'm assuming the results here are going to be the same.
It's funny that, in periods where the market's going up, and what is it, 7 out of 9, 70% of the time the market is going up.
Right.
And so they're betting on 30% of the time going down.
But some people wake up in the morning and they feel like that they're part of that 30%. I mean, the stock market, I know people, the stock market is going to be crashing for the last 10 years. I don't know what the 10-year rate of return of the S&P is, but it got to be in triple digits. So didn't exactly happen.
So this is an ETF from First Trust called First Trust Long Short Hedge Fund. Symbol is FTLS. And when you put that with VTI, which is the stock fund that we are using as our benchmark, it optimizes it somewhere around 25% in the hedge fund and 75% in the stock fund. And again, we have an expected return of 6.7 and a risk level of 15. So we're reducing the risk from 18 down to 15, but the return is only being lowered by 0.4%. Now, this type of fund has a higher cost structure than
I'm looking at that now.
160 basis points, I believe.
1.6% annual fee.
Yeah.
That's crazy.
And the returns aren't great in terms of, it's always betting on the correct side of the market, because whenever the market's going up, they still have up to 50% of the market investments expecting to go down, invested in such a manner that they go down. Right. But in this type of environment where you're trying to optimize and lower your standard deviation or the risk, it has a positive effect.
It did lower the risk. I mean, the S&P over the last year is up about 13%. this fund. I don't want anybody run into this fund because it sounds perfect, right? It's actually about up 8. So FTLS has made money, but not in the last not in the last year compared to the S&P. Now, this year we're in a down market. It's still down. It's down, I guess, about 4%. S&P's down 7.5% at the time we're recording this. So it is down less, but quite honestly, you could probably replicate the same thing with the S&P 500 low vol index, and it'd be a lot cheaper. And I have to go back and actually research to make sure that's actually true, but that's just what my thought is.
Sure.
ETF.com gives them a D rating overall, but I don't know. That's interesting. I remember when all this stuff was coming out, and I'd read about it and then end up dismissing it because when the market is up more than it's down since the beginning of time, you just have to weather the storm. So you can get through all this a lot cheaper if you just weather the storm. Keep enough cash in reserve so you don't have to worry about these crazy strategies. It's been probably 5 years ago, Brad. I think it's obviously before you joined us, but I was hired by a family to come up and to find the best hedge for the market. What's the best hedge? How can we protect ourselves from the downside, right? So I go and I research all these options. You know what the best hedge is? Short-term treasuries. Mm-hmm. It was cheap.
I was going to say cash.
I know. It was short-term treasuries was the best hedge. If you want to reduce volatility, add short-term treasuries to a portfolio.
Right.
So whenever I see funds like that at 1.6%, it sounds great, and I could probably sound really smart telling our clients that we invest in this, and this is what it does, but it doesn't work long-term.
Yeah, I don't think they're meant to be, the sole investment that somebody makes.
No, definitely not. Right. But even if it was 10%, I'd say that's pretty cool. But as a practitioner in this field, I would be embarrassed for the advisors about that.
So one more example where we're going to look at the all stock portfolio and then add a commodity ETF, a broadly diversified commodities ETF that's energy, fuel, oil, corn,
right,
pork bellies, pigs.
I'm interested in this because we held commodities in our portfolios for over a decade, and I determined that commodities were no longer a long-term healthy asset class. Until in the last 6 months.
Well, yes,
but you held it for, in our case, 2 decades to make money over the last 6 months.
So a portfolio of 2 asset classes, a diversified commodities ETF and a diversified stock ETF. The commodities ETF being DBC and the stock ETF being VTI. If you put about 2/3 into the stock ETF and 1/3 into the commodities ETF, you'd optimize your portfolio where your expected return is about 6.7% and the risk or standard deviation is about 15.3%. So again, you're getting this reduction of volatility in a greater proportion than you're getting a reduction in your return.
Yep.
Okay, and so that's the effort that's taken generally in order to have a more predictable return stream or amount at some point in time in the future by reducing your volatility, okay, or really your expected return.
Yeah. I mean, if you held a commodity ETF that I follow is DJP. It's actually an ETN, exchange traded notes, one of the first commodity options we had in ETF world. But you don't actually own anything. It's a promissory note.
Right. It's all futures contracts.
Correct. So if the bank goes out of business, you're going to lose all your money. So it's probably not the most efficient way to do DJP or to do commodities, but you don't get the K1. You get the K1 with the alternative.
With the alternative structures. Right.
So that's why we used to use DJP. We haven't owned it for years. But I mean, it's a great investment to add that right when the newsreel starts talking about inflation. December 16th of last year, right? Everyone's super worried about inflation. Even at the beginning of the year prior in 2021, you had a pretty good return, but big bounce here recently. But I still think that's probably a short-term play. I have a hard time owning something in a portfolio that doesn't pay me some sort of income, right? And Warren Buffett does too.
Right.
So we own gold, precious metals. I mean, we haven't really touched on that today, but that's a whole nother.
No, that would be a commodity. So it might be in the commodities fund itself. But
we have a whole podcast on probably just commodities and gold and all that stuff.
Right.
So what was our? I was looking at DJP. What was our final answer on the
final answer
on your broad commodity index fund?
Well, it lowered the expected return from 7.1 of an all stock portfolio to expected return of 6.7
over what time period?
Over long-term capital market assumptions over futuristic expected return.
So 10 plus years.
Exactly.
Okay.
And it's lowered the risk from over 18 to just over 15. So again, the proportionality of the lowering the return is less than the lowering of the risk. So you're getting the benefit of the addition.
Of all these options, it sounds like real estate was the best one because I'm getting income while I'm holding it.
True.
It's not as correlated with the market.
Right.
Right?
Yeah, I think real estate has a correlation of around 0.65 with the general stock market. So you're getting non-correlated return streams, you're getting income, and you're getting price appreciation.
Correct. Mm-hmm. It doesn't mean that hedge funds are bad. It doesn't mean private equity is bad. But you have to evaluate each opportunity as it comes to you.
Exactly. And what's available to you as an investor in your portfolio that makes sense, given your everybody's unique circumstance.
Absolutely.
Mm-hmm.
So one of the things that I think we haven't covered as much is there's also private debt. We see clients do this for companies is they'll get 12, 15% on a loan to a business. Loans it's collateralized, sometimes it's not, but private debt to a family member should never loan money to a family member. That can be very difficult, especially large sums. So anyway, outside of that, if you have an opportunity, someone comes to you and say, hey, I want you to we're trying to buy tractor trailers for our hauling company. And so you could finance tractor trailers and there's collateral, right? Mm-hmm. So there's deals like that we see quite often. It does not involve us at all. It's just deals that people find and we document that into their plan and their net worth statements. And
right.
So anyway, there's those opportunities that are a little safer because you have collateral. Just got to know the people and do your due diligence on that end.
And some of this is all being democratized as well. I think we mentioned earlier, things like crowdfunding. You have web online platforms that allow you to invest in private equity and other types of investments, or provide capital to somebody to start a business. Okay, through these different measures, and you don't have to be an accredited investor to do that.
Yes. Okay. Well, that was a good exercise, Brad. Thanks for doing that research for us and sharing your knowledge on alternative asset classes. And again, it's not a big focus that we have here, but it's almost like it's very client specific. It's not something we make a broad recommendation on.
No, but in the right circumstance, it can be the right thing.
Yeah. Absolutely. All right, Brad. Thanks for your time.
Very good. Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.